Everyone, and thank you for everyone who registered and is attending today. My name is Paul, and I'm here with David McMillan to run our June quarterly market update. I'll just take you through a couple initial slides first, but we've been running these quarterly market updates for a couple of years now. This will actually be the last in this format as a live webinar. As part of our move to our new portal, we're going to be releasing more frequent market updates through the media section in our portal, which I'll just give everyone a quick update on now before I hand over to David. So the portal invites have been sent out. The portal in its current format is in its very early stages in terms of what's been released to date. Clients at the moment are able to view research reports, investment options, and our referral program. The release that will be coming out over the next week includes access to the full system, which will include things like advisor notes, the portfolio modelling, our statistics, as well as a few other areas like our media section. I'm just going to quickly give everyone a view on how that looks. So this is the live view now that we're going to be releasing. As a client, you'll be able to log in, you'll be able to see who your advisor is and book in meetings and calls. You'll see some key portfolio metrics up the top, as well as your property portfolio here. You'll be able to look at your client profile through this section, your portfolio account and all of your assets in here. You'll be able to view things like advisor meetings and the notes from those meetings. You'll be able to view some recommended actions from meetings with your advisor. And this integrates in with our property management team, who, when we're managing the property, they'll receive notifications around actions from meetings as well. We've got reporting in here in terms of our consolidated reporting and tax reporting as well for end of financial year tax time. Our research will be in here, investment options that we're looking at, and then this media section. So in the future, we've just got a couple of test items in here now, but in the future, instead of running these as live webinars, we'll pre-record, as I said, more frequent market updates and podcasts, and we'll put them in this section, and our clients will receive notifications when these new updates are made. So as I mentioned at the start, the invites have all gone out. If for whatever reason you haven't received your invite, please reach out to us at the address here is portalsupport@performanceproperty.com.au, and we'll make sure we get an updated invite out to you. As I said, moving forward, we are setting up the portal so that all our correspondence and communication, everything goes through that central location. Okay, so I'll hand over to David McMillan now, who'll run through the market update. If anyone does have any questions, there is a chat area where you can chat, and I'll just open that up now for questions. So if anyone does have questions, please enter them into the chat area, and we'll get to those at the end of the presentation. So I'll hand over to David, and if you want to start sharing, David, you can take over from here.
Thank you, Paul. Let me share the slide deck. All right, so Paul, let me know if you can hear me.
Okay. Yeah. Good.
All right. So just a general disclaimer, this is general information only, and if you want specific advice, please reach out to your advisor, and you can discuss them one-on-one as they relate to your circumstances. So we've really honed in on simplifying the way we communicate what we do to clients, and fundamentally clients are fitting into two categories at the moment. So the debt reduction strategy, where they're trying to pay off their principal place of residence, and then once they've paid off their principal place of residence, we're moving to a model portfolio. Those model property portfolios are increasingly done with the collaboration of a financial planner, which is not a big shift. We've always done that, but very purposefully we want the financial planner to be involved. So we're giving advice, not in a vacuum, but in reference to all the other things going on with your finances. Here
Sorry,
is-
David, I might just, for some reason your presentation isn't coming up.
Yeah.
Oh, there it is. Yep, it's up now. So I don't know if it was just.
Well, that's when I go to full screen, Paul. So
Yeah. Okay. Well, if you like, I can share my screen and I'll just flick through the slides.
yeah, that's
That's
probably
useful. Yep, that's fine. All right. Here we go. Okay.
perfect. Yeah. So as I mentioned, as we've become more streamlined in what we're doing, we're putting clients into two baskets. One is we're trying to pay off their principal place of residence, and we've got strategies that match that objective. And then the other one is a model property portfolio. And as I mentioned, increasingly this is done in collaboration with the financial planner. So we're looking at the whole picture, not part of the picture. Next slide, please, Paul. These are the phases that we take clients through. Obviously, we can cater for a client if they're just getting started in a rent vested capacity, and equally we can cater for a client in that wealth creation or retirement phase. And we've got strategies all the way through, depending on your circumstances. What we always start with is growth focused residential property, and then as clients move through time and there's a focus on preparing for retirement, those strategies more and more turn towards income, and hence the collaboration with a financial planner. Next one, Paul. So we'll just go into the methodology, the core methodology. This has been on foot for years now, and depends on the client strategy. But fundamentally, we put property into two categories. One is a trading category, and the other one is a foundation category. So trading, explained simply, is we're buying the asset to sell for a profit in a 6 to 9 year period. What success looks like in that strategy is 60% capital growth, and that's the primary tool that we use for debt reduction. So we'll sell the property, we'll pay the capital gains tax, pay back the original debt, and the net proceeds will go to paying off principal place of residence debt, or principal place of residence debt. And if that's paid off, we would look to pay down other investment debt. Once we've paid off the principal place of residence, we then move into a hybrid of trading and foundation strategies. And those foundation strategies involve buying properties and holding them for the long term, buying quality assets. They could be resi growth assets. They could be balanced assets like unit blocks, and of course income producing assets like commercial property. And we'll show you some examples at the conclusion of the webinar. All right, so let's get into our property research. And 80% of our clients are still in that debt reduction phase, trying to pay off their principal place of residence. And so when we're engaging in that trading strategy, buying a property, trying to sell it for a profit, the way that we've gone about property research has been paramount to our success as a business, which is measured by our client success, by the way. So we'll just go into some of the fundamentals of that research. We've always had the property clock. When we started the business in 2013, we had our first version of the property clock. This is like, I would say maybe the 120th version of this clock, because we've been releasing it monthly. The clock forecasts have been getting more and more accurate over time. We've invested millions and millions of dollars into making this as accurate as possible. And as you can see at the moment, there's not too many markets in the buy value stage, which is where we want to be. We want to be buying in that buy value stage, and then we want to give our clients the option of selling in that hold to peak stage. So Melbourne is coming down into that buy value stage, which is probably the main story from this webinar. But there are equally some really good markets to still get in and get out of, trade through, and that's some of those markets you see in that buy momentum phase and still that buy value phase. Next slide, please, Paul. We have innovated the way that we're displaying our view of markets, and one thing that the clock does not measure is it doesn't specifically measure how much growth we think is left. It just gives an indication of where it is in the cycle. And the other thing it doesn't measure is the amount of demand in that market. So we now have a more sophisticated model to give a visual on markets. We've been working on this for years. We've just started to release it in the last 12 months, and it's becoming more and more accurate. And the evolution of this is basically to take it down to a suburb level, which we're working on at the moment. We've already gone through a number of prototypes. So where you want to be, clearly from a trading perspective, is you want to be in a market that has high demand and has long runway. So that's that top right-hand corner there in blue. That's where you want to find markets to get a really good trading outcome. And as I said earlier, what success looks like in a trading outcome is 60% plus growth over that 6 to 9 year period, which we've been able to do consistently over the last 10 years. So let's have a look at the locations around the country in the context of that framework. And you can see that this is for houses specifically. You can see that the left-hand axis there is demand, our demand score, which is unique to our business, and then the right-hand axis is runway. And it might be a little bit small for people to read, but Darwin, for example, has 100% runway forecasted at the moment. That's Darwin Houses. But the market that is still in the most demand in the country is Perth. And when you look at that demand score, it incorporates a number of things such as days on market, stock on market, dwelling approvals, population growth, rental changes. It is quite an intelligent score that we've come up with. And it basically says that, you know, when you look at the market as a whole across Australia, Perth is in the most demand right now. The other thing that market tells us is if you take someone like Launceston, supply exceeds demand. So there's too much supply for the amount of people looking to rent or buy in that market, and therefore price falls are possible in that market. Certainly price softening, which we're seeing in some markets as the cycle evolves. We'll have a look at the next slide, which is units. And you can clearly see a different picture for units, even in the same cities. And I think the takeaway from this this chart is that units have more runway than houses. And that's a reflection of there's just way more affordability in units, and therefore units have become a big part of our trading strategy. Quality land content rich units have become a big part of our trading strategy, which, you know, was a pivot about 3 or 4 years ago from our side. We don't hold units really long term and under a foundation asset strategy, but we're certainly trading lots of units at the moment, and we think that that's probably where the most amount of growth is going to come in the next 5 years. And you can clearly see like markets like Townsville, which we're very active in at the moment, you know, has 150% growth forecasted for units. So this is a different way of viewing markets other than the clock. It probably provides more of a story and gives it a little bit more meat for us to base our decision making on. And these charts are effectively changing every month. And the investment committee meets and discusses all these charts, and then obviously sets the advice framework for all the advisors that you'll meet on an annual basis. Thanks, Paul. Next slide. So let's just go into the data a little bit. We always like showing this graph because when COVID hit in March 2020, all the papers were saying, you know, price forecasts, they were forecasting price drops of 40%, right? So the number one rule for property investors is to not listen to the media to base your decisions on. Usually they're wrong. In fact, I would say they've got a high probability of being wrong. You know, they tell you to sell in markets that you should be buying in, and they tell you to buy in markets that you should be selling in. So don't listen to the media. But there's been some extraordinary growth over the last 5 years across the country. And we've been in most of those markets. So you look at Adelaide, we've been in, you look at Brisbane, we've been in, you look at Perth, we've been in, and we've avoided markets. We've avoided Melbourne. And so that's really our job. Our job is to read, you know, the data, interpret it, and provide advice, and make sure that you're on the markets that do well, and you avoid the markets that are going to do poorly. And I think we've done that fairly well over the last 6 years. And you know, our intention is to always get better at that data analysis and therefore that advice. Move on to the next slide, Paul. So the story hasn't changed for a long period of time. So, you know, apologies if this is getting repetitive and you join this webinar a lot, but the story was interest rates for a period of time. And I think we're on record as saying that long after the story of interest rates goes away, we will be left with this very severe supply problem. And so you can see these are the capital cities. You can see the vacancy rate's been trending down since 2020. We haven't been building enough, and now all vacancy rates are sort of 2.5 or below, and a lot of them are below 1%, which effectively means double-digit rental growth, which is great news for property investors. So when we look at the next graph to explain and look at the future, you can clearly see, during COVID we had no overseas migration. So the overseas migration is the bar, the light grey bar lines that you can see there. We had no overseas migration 2020, 2021, and then we've made up for it and some in 2022, 2023, 2024. So those migration numbers are huge. That's what's been driving a low vacancy rate, together with the fact that we just haven't been building enough dwellings to keep up with the amount of people coming in. And so if you go to the next slide there, Paul, this is dwelling approvals, since 2021. It's not commencements, it's approvals. And even though dwelling approvals are down, dwelling commencements are down even further, because there's a lot of sites across the country aren't feasible with the rise in construction costs, especially in places like Melbourne where there hasn't been price growth. So if you go to the next slide, the end result of there being too many people and not enough bedroom production is rents must rise. And we're seeing that clearly as a national trend with rents going from $490 in 2020 to $730 across the country, and we're seeing very exaggerated examples of that at a macro level. At a capital city or a regional level, and we'll share with you some of those stats. But if you think about it as a property investor, these are pretty significant tailwinds. So demand should exceed supply in most markets for the next 3 years. The state government, federal government, they're trying to keep up with bedroom production, but they're not succeeding. And as you know, without a solution, the only outcome is rents are going to continue to rise. Again, these are really positive tailwinds for property investors. So next slide, please, mate. So we'll go into Perth, which is a market that if you're a client of ours and you have been for some time, hopefully you own property in Perth. It's been a great success story for us. It's up 70% since 2019. It continues to show value. Affordability is becoming an issue, but of course on a sliding cash rate, you'll see the affordability index come off. So the affordability index is at 43, which is making Perth look like it's coming up to being, expensive. But as the cash rate comes off, you'll see that drop, and then you'll see another surge in prices. That's certainly the view that we hold at the moment. So if you're holding property in Perth, houses that is, you definitely should keep holding. We don't think it's anywhere near a sell rating, and we are still accumulating the odd house in Perth, but mostly now accumulating units, as I mentioned earlier. So if you go to the next graph, the slide, Paul, this is price to income. So the average house price to the average income. Perth peaked in 2006 at 7.5 times, and now it's back up to 7 times. And for units, it's at 5 times. If you want to compare this to Sydney, Sydney's got a price to income of 14 times. So by comparison to Sydney, this looks cheap, but it's certainly getting to a cyclical peak. But again, we think it's got a lot of room to grow. This is just one of the indicators that we look at. Go to the next slide, please, Paul. Here's where you can see, when the market started to run, and we got in this market actually in 2018. And prices softened a little bit, and that made people nervous who got in early. But then from 2019, it's been nothing but good news. And some clients have had prices rise 100%, depending on when they got in. Some are at 70%, 40%, et cetera, et cetera. So we've ridden this cycle really well. But where we're seeing most of the value now is in units. Units have had less growth. Units have further runway. Units are in more demand than houses. So we're still playing this Perth theme, but we're playing it a little bit differently than just houses. We're doing houses and units, but mostly units is what we're buying. Next graph, Paul. This just shows the relationship between houses and units over time. So on average, the Perth unit price is 84% of the Perth house price, and at the moment it's down at, is that 71, Paul? Yeah, it's 71. So it's saying there's more value in units than there is houses, and there's still value in the Perth market. So that's really why that's been a focus of ours. Next slide, please, Paul. This is household lending for owner occupiers and for investors. And, the trend from 2023 is up, although it's been flat lately. Certainly the trend from 2023 is up. And what we should see on a falling cash rate is this trend pick back up. But this is a fairly neutral indicator, actually. Next one, Paul. Stock on market still at record lows in Perth. Days on market also at record lows. So there's still demand in the market, as we saw with that demand score, but less demand than probably what there's been, say, in the last 2 years. We've had a good couple of years of double-digit growth. This year, it looks like it's low single-digit growth, but I think when that cash rate gets down to the early threes, we'll resume back to double-digit growth and see out the full potential of this market. And then the last graph, I think, is, this is a very sexy graph for property investors. So the rent in 2019 was $439, and now it's up at $831. So you've had 100% growth in rents in Perth on a very low vacancy rate. And that tells us clearly that the market has nowhere to go but up, because they're not producing enough dwellings in Perth. The population's still coming into Perth. The rents are going through the roof in Perth. The yields are the highest in the country in Perth. And so this story's got some time to play out. And what we're doing now is we're playing that affordable end of the market, which is units, as we discussed. All right, so we'll change of pace. We'll just skip that slide. Paul, change of pace. We'll go over to Sydney. So this is the affordability index in Sydney. So the affordability index, if I didn't explain it properly earlier, is the percentage of the average wage that goes to the average new mortgage, assuming an LVR of 80% and the current variable rate. So what this is saying right now, 80% of the average wage goes to the average mortgage in Sydney, and that's before tax. So it's obviously not possible what's been happening on a single income. It's obviously been happening on dual incomes. But what this tells us is Sydney is incredibly unaffordable for houses and has been for some time. And you can see that over since 2023, when the affordability index got right up there at 85%, the Sydney market has been softening. So this market, we've got it as in the stagnation phase, and one of the primary reasons why it's in the stagnation phase is because of affordability. Next slide, please, Paul. This is price to income in Sydney. And a little while back, we did a worldwide study as to the highest price to incomes in the world. And of the markets that didn't allow foreign capital into their markets, no market ever got past 14 times without correcting. So it's interesting to see that the Sydney house price has got to a price to income of 14 times and hasn't been able to get past that. And it's hovered around a price to income of 13 times, and it's now softening at 13 times. And if you think about a house price 13 times the average income, what it means practically is it's incredibly difficult to save a deposit. Incredibly difficult. And so most people just give up or move or some other variation of that. There's been a huge intergenerational wealth transfer in Sydney to keep the market at current highs, but it hasn't been enough of an intergenerational wealth transfer to push the market to another level. So these indicators in Sydney from an affordability perspective are screaming red and are telling us that there's limited chance of the market running. There's always a chance, but there's limited chance. There's no fundamental reason why it should run. Next slide, please, Paul. This is showing the run, and you can see since 2023, the market's come off a little bit. And, this looks like the start of a correction in Sydney, and maybe prices might correct back to 2020, perhaps. We might get to 2027, 2028, and house prices are back to 2020, and maybe there's another value opportunity in Sydney. But we really need to see years of stagnation or some serious price softening to consider that market. Conversely, units, like if you go back there, Paul, and you look at units in Sydney, they haven't done much since 2016. So over the last 9 years, they're only up 10%. So there's definitely a value opportunity brewing for Sydney units. And if you go to the next slide, it demonstrates that this is the relationship between Sydney houses and Sydney units. Sydney units are at record lows by comparison to Sydney houses. So usually Sydney units sit at 84% of the Sydney house, and now they're down to 57. So that's showing for Sydney, that's showing that houses are incredibly expensive, but it's showing units by comparison are cheap. And so the pressure in Sydney may go towards units. And just speaking to a couple of people on the ground today in Sydney, actually, they said that Sydney units are in demand. There's not enough runway on Sydney units, though, for us to put it forward as a trading strategy. But it's certainly somewhere where we think if you parked money, it would be a good outcome. But there are better alternatives out there. Next one, Paul. This is household lending. You can see there's been a pretty steep drop recently, but it's fairly flat, so that's a fairly neutral indicator. And we can see, and this is the start of the story of the stagnation, stock on market, days on market beginning to build in Sydney. So you can see days on market have gone from 30, which is a fairly balanced market. You know, you'll have one or two buyers at 30, up to 32, up to 33, but stock on market's gone from 26,000, 27,000, and now at 32,000. So stock on market is starting to build. Days on market is starting to build. There's no affordability. Price to incomes are off the charts. You know, the prognosis for this market is that we'll probably see years of stagnation. Thank you, Paul. That's the vacancy rate. Sorry, the other thing that's screaming green with Sydney is, although that it's completely unaffordable and it's got some serious challenging, rents have gone through the roof. They've almost doubled since 2020 on a low vacancy rate. So there's a lot of demand in Sydney, but there's no affordability for houses. So maybe that's case for a run on units, and we're certainly tracking it in real time. Melbourne. So I'll try and keep this quick because I want to open up for questions. Melbourne is probably the most exciting story at the moment. We have started to buy back in Melbourne, largely for a foundation asset strategy, but the investment committee met on Friday and we've just opened up a trading strategy for units. We see 75% runway in units in Melbourne now, this cycle coming, and that could open up depending on income growth and interest rates and a few other things. But Melbourne houses are fairly fully priced. Just looking at this affordability index stat, but don't forget we've got maybe 100 basis points of interest rate cuts, which will drop that right down in Melbourne and maybe the start of a upward cycle. Price to incomes in Melbourne have slipped back to 8.2, so they're where they were in 2015, and you could argue they're pretty close to the 2012, 2011 period, which is when the bottom of the last Melbourne market was. The price to income on units are looking pretty good. They haven't changed since 2010. So whilst affordability, like at a affordability next level, is a challenge, price to incomes are starting to look good. Next slide, please, Paul. We can see, and this is probably one of the most important signs for Melbourne. You look at Melbourne, it peaked in 2018. It peaked at a median house price of 800,000. And you can see the trajectory that Melbourne's on. It looks like it's going to get back to below 800,000 this year, and maybe we enter 2026 cheaper than 2018. The last time Melbourne had a stagnation like that, which is an 8-year stagnation, was back in the 90s, so 1989 to 1997. So, from a price stagnation point of view for both units and houses, the Melbourne market is looking like a value opportunity. And there are other points of consideration which are not in here, but Adelaide, for example, is going to be more expensive than Melbourne, and the last time that happened was 1984. So we've got a buying in Melbourne slide deck, and there's a whole bunch of reasons why we think Melbourne is showing value, but we're just sharing a few with you today. When we go to the next graph, this is just another interpretation of looking at where the Melbourne median house price is, 822 against a 2018 high of 790. And we're looking at the relationship here between Melbourne units and Melbourne houses. Usually Melbourne units are 83% of the average house, and now they're down at 72. So units are looking good. Houses are starting to look pretty good. If you go to the next slide, Paul, one thing is happening. Whilst it's becoming affordable and the metrics are starting to open up from Melbourne, one of the things that Melbourne's going against it is stock on market and days on market are still building. So what that suggests to us is that the bottom of the market is close, but it could be further away. So the danger of coming into Melbourne now is you're a little bit early. But for some investors who have already done well in Adelaide, done well in Brisbane, done well in Perth, some of the best calls we made were to go into certain suburbs. So we are definitely buying in Melbourne. It is definitely the next market where we'll be buying lots of property, but we're just starting that buying program now. Brisbane, I think Brisbane's the next one. We'll just go to Brisbane. So Brisbane is getting to a point where it's fully priced. This is the affordability index of Brisbane. It's getting right up there. Everyone talks about the Olympics in Brisbane being, the reason why the market will keep going. When a market gets fully priced, usually it doesn't keep going, Olympics or no Olympics. So we're looking at Brisbane as having a great year in the next 12 months, maybe the next 24, but we've certainly got our eye on selling a lot of property in Brisbane 2027-ish. A lot of clients have made a lot of money up there. Most of our clients who got in early have doubled their money. And now that's not only true of houses, but also of units. They have to wait a lot longer for units. But Brisbane is sort of becoming fully priced. You can see that through the affordability index. Next one, Paul. You can see that through the price to income. It's now at record highs and some distance away from, its previous record highs. You look at the next graph, please, Paul. It's gone on a run since 2014-15, started at a median price of 500 and now it's sailing up to $1 million. So that'll be a full doubling cycle at a median level. And as I mentioned, we've had a lot of clients that have ridden that cycle who are very happy. We're close to putting a sell rating in, but we still think there's more runway in that market. So we're not discussing that this year, but we're thinking about that for next year. Stock on market, as you can see, is still on a downward trajectory, and days on market is still flat. The market is fairly robust in Brisbane, trading fairly well off a high base. I think, depending on what happens with interest rates, it should have another solid bump, and then there's probably a selling window open up. So we're tracking that every month for obvious reasons. Rents are up in Brizzy, but starting to level off. So you look at, rents from 2020, 512, now they're 758. So rental growth is slowing. It's showing signs of a market that's kind of running out of steam, but got a little bit left. And we'll update you if you've got property in Brisbane in your annual reviews. So commercial update. Look, the commercial market's still pretty tight. There's limited volatility in there. If you're looking at quality defensive property, there's yields in the marketplace still at 4.5, 4.6, 4.7. We're trying to buy on yields of between 5.25 and above, depending on the product. We're also looking at buying properties on low rents where we can get a rental adjustment, and then we might buy on a 4.5% yield, but within 12 or 24 months we can get it up to 6.5. So we're still not doing huge volumes in our commercial market because there isn't huge volumes to be had. We are very picky, but it's still a fairly tight market. And if you're looking for commercial property, the briefs are 3 months to sort of 6 months. Next one, Paul. What we're buying in commercial, we're obviously buying principal place of businesses for medical professionals. We're buying passive income producing assets, quality commercial property at say 5.5. The rental reversion I just mentioned, where property's under rented at the moment, but through a rental review in 24 months we can get yields up to 6%. So we're doing a bit of that. We also think development sites, depending on the income, that story is looking, we've got an undersupply of property. Development sites, no one's valuing them at the moment. A lot of them are distressed. If you can get appropriate income on them, that is a good strategy for the right client. And then, there are some deals out there at the top end, but that's sort of, we don't have heaps of clients at that bracket, but we're noticing lots of value. All right. I think, so we'll just quickly go through the examples and open up for questions. So this is something that we're buying in Melbourne, so the quality terrace, single front, double front, we're buying lots of. Yields aren't out of the park yet, but we're relying on interest rate falls. We're relying on rental growth. So the cash burn's quite high, which is why we don't have lots of clients. But this is the sort of stuff we're buying it, and we're saying to clients, put them in your portfolios for the long term, because now's a really good cyclical point to get in. We're buying, that's a classic buy for us. Next one, Paul. Similar here, almost the same product, different suburb. And then, of course, we are buying a lot of land content rich units. A lot of dual locks, 1 of 4, 1 of 6, 1 of 8, 1 of 10. We think these are very underpriced at the moment, depending on the suburb. And some of these we're buying for the long term to hold, and some of these we're trading out of. Here's a good example of something we've bought in Perth that's done incredibly well. We bought a lot of quality terraces over there, older homes, classic suburbs. And here's an example of a commercial property. This was bought for a principal place of business for someone, but it's a 1 of 2. So they got to move into this place, and the factory next door produces income for them. This is one we bought recently, which was that rental reversion story. So rents were about 30% below market when the tenant leaves in 12 months. that will resume to market, and this property will probably have a value uplift of somewhere between $500 and $1 million almost straight away. So that's a really good example of something we bought recently. That was in Tullamarine, that previous one. This is in Noosaville. This is a fairly vanilla blue chip renter in a blue chip location on a solid yield. You put this in your portfolio all day long, depending on the portfolio size. Questions, Paul?
We had one there, Dave. So just from, excuse me, from Sean, just in relation to the runway. We've spoken about the percentage runway, but Sean was just wondering about the duration.
Great question. So maybe you can go up to that slide, Paul. So the duration is one of the hardest things to forecast because, we don't know what's going to come around the corner, and interest rates could go up or go down. COVID's a really good example of that, right? We think, based on the information that we have right now, that is how much runway is in the market. The time frame upon which that happens, we have no idea. But we can give a range, and that range is sort of between that 3 to 7 year period is probably a fairly good guide. But we've been blown out of the water many times. COVID's a good example, and then recently, we thought we'd have, say, more growth in Perth, but the cash rate went up to above 4%. So the cash rate influences the time frame, as does broader sentiment, immigration policy, dwelling approvals, etc. What I think the best way to think about this is the forecast for the medium term, and the medium term defined over the next sort of 4 to 7 years. Things can happen quickly, or they can take longer for reasons that we don't yet understand.
And Dave, maybe just important to note that with this chart, we're tracking this monthly, and over the coming 12 months, what we should be able to have for each market is an actual movement chart. So you'll be able to actually see the movement over periods of time.
Yeah.
For each of these regions. So each region will have its own chart. You'll actually be able to track on that chart where it's been and potentially where it's heading, so that we can start to look at the direction. And if we come back to this one here, we can actually see which quadrant different regions are moving into or out of as well.
Yeah. More questions, Paul? I think
yes, the next question here from Gareth. Can you give me a 1 to 2 minute summary of the Adelaide market?
Yeah, look, depending on the suburb in Adelaide, it's coming up to a point where it's getting fully priced. So not every suburb is fully priced, but it's coming up to a point where it's fully priced. We've got roughly 20% runway forecast in Adelaide. And, depending on when you got in, what suburb you bought in, there's going to be a lot of advice that this is the selling window. Days on market is still coming down. Stock on market is still coming down. The market is trading really well, but we think once the cash rate actually gets down to 3.1 and stops, the Adelaide market may not keep momentum past that point. So, I would say there's a 50-50 chance that if you see your advisor and you've got a property in Adelaide, he or she will be advising you to sell at the end of the tenancy. Hopefully that summarises things for you, Gareth. The market's good now, but I reckon 12, 24 months it may soften up.
Ross, thanks for the update. Can you talk about why and what you're buying in Townsville?
Yeah, so if you just go to the
sorry,
demand,
Rosa, that wasn't Ross. Sorry.
Yeah, Rosa. Yeah. So Paul, if you can go to the demand score and you look at Townsville, where it is on the map. So the reason we're buying in Townsville is because demand exceeds supply. That's a function of people going in there and not enough bedrooms being built. It's always the case. And then we look at the job vacancies, and we take a view of what's happening with infrastructure on the ground, and we think about how sustained that population growth is going to be. So we think the Townsville story is a great story right now. And no one's building in Townsville because, at the moment, if you want to build a townhouse, it costs $750,000, and those townhouses are trading at, we can buy them at $475,000, $500,000. So no one's going to build anything. There's going to be rental growth there for some time. It's a get in, get out strategy. We like it. I bought some property personally there today. Hopefully, if Frank's listening, Frank's trying to close a deal for us. So it's a good story, but it comes with it comes with certain risks. It's a small town, things can change quickly, but your advisor will walk you through that. Next one, Paul.
We've got Roger, where you put Perth and, yeah, Roger, so where you put Perth and Melbourne houses on this 2x2 performance window.
Okay, so if you go back to the previous graph, so you look at Perth. Perth's got 75% runway forecast and is in the highest demand in the country. And then you look at Melbourne. Melbourne houses, they are at 50% runway, and thank you, Paul, and 30% demand. So, what, Paul? Maybe just give a graphic of where we think Melbourne houses are going to go, the direction they're going to go on this graph, right? Melbourne is probably going to become in more demand and have wider runway. Can you draw that on the map? Can you draw that, Paul, or not?
Yeah, so it's sort of going in this sort of direction up here.
Yeah, that's correct. And then draw the runway, draw the trajectory that we think Perth is going to go.
So
as it grows in value, where's it going to go?
Yeah, so Perth sort of comes the opposite direction around.
That's correct. Way. That's correct. And that's how to interpret this graph. And you'll start to see a bit more of a visual of that over time, as Paul was saying. And hopefully these concepts make sense to you and give you an insight into the level of thinking that goes on to give the advice. You know, it is very sophisticated, and it's becoming more sophisticated as we get access to more data.
And so those little squiggly lines that I was drawing, they're the sorts of things that we're trying to chart in the movement, and we'd love to be able to present, to show over the last 12 months, month on month, how that movement and that trajectory is happening.
And Brian's got another question about Alkimos. Brian, I just would encourage you to discuss that one-on-one with your advisor. Yep.
Tim, units in Melbourne, what's the purchase price range there and the entry points?
Look, the lowest entry point, Tim, is probably around that 700 mark. We still got to get the quality and we still got to get that land content that we're after. Purchase costs, mainly the lowest entry point. Yeah, so it's probably 700, Tim. Hopefully that answers your question.
Pete, on the strategies, so why use a foundation strategy if trading is more profitable?
It's a good question. So trading comes with its own unique disadvantages. That is, you've got to pay stamp duty, buyer agency fees, holding costs, then capital gains tax on the way out, as well as transaction costs. So the reason why you trade in and out of properties is because you run out of borrowing power, right? Once you've paid off your home and the home's fully paid off, it's not to say that you don't stop trading, because you will still do some trading, but it is to say you start to focus on buying assets for the long term, so you avoid those transaction costs in and out. And as we mentioned, we do that in collaboration with a financial planner, and we're really just looking at the IRR on the trading strategy versus the benefits of holding property for the long term, and there's some modelling that's done. But it's just to say that trading is very appropriate when you're trying to pay off your principal place of residence, and trading is then less appropriate when you're in that model portfolio stage. You still engage with it, but just to a lesser extent, depending on your circumstances.
And important to note that all of our advisors are trained up on these strategies, and if you want to have an individual discussion around these, reach out to your advisor. And I think that might be it for the questions, Dave. So thank you for the update. Thanks again to everyone who attended. Once again, jump onto the portal. We will be releasing the media section and other features over the next week. And obviously your advisor will be running meetings through the portal from now on. So we'll leave it there, and have a good afternoon.
Thanks, Paul. Thanks, guys. Thanks for coming.
No worries.